You might have heard recently through the media that there's some pretty alarming headlines about how Sydney and Melbourne markets in property have dropped by 10 to 15% in the last 12 months. You'd be forgiven for worrying that the whole market is looking negative and it might not be a good time to invest in property. But did you know that while Sydney and Melbourne have been going backwards, there are hundreds of markets that have not only grown by 5 to 15% in the last 12 months, are forecast to grow by above 80% in the next 8 years. So it's around about 10% per annum. So the secret is to understand the market and understand what drives the market and know where to get good research and advice from to find those markets. So to help you understand that, let's have a closer look at the Sydney property market. This is Sydney median values for the last 50 odd years. You can see down in the bottom corner, in 1973, the median value of property in Sydney was just $29,000. To recently, before the drop in value, Sydney peaked at about $1.1 million. Now that was an average growth rate, compounding, of 9.5% per annum, and that's the dotted line. But you can see that the market doesn't grow consistently, there's a cycle. And that cycle is roughly 7 years of boom and 7 years of plateau. And of course that's never exact. Sometimes it's a 4 years boom or a 4 years plateau, or longer or shorter. But there's a reason the market behaves like that, and it's mostly human behaviour. Now the orange line is property values with inflation taken out. So you might look at the normal value with inflation and think it's just about impossible for property to grow that amount from $29,000 to $1.1 million again. But what our brains don't do very well is take out inflation. So if we do take out inflation and go backwards in value, property has really grown from, in today's dollars, by about 200,000 to 1.1 in nearly 50 years. So when you understand that, it helps you understand what is sustainable growth and what the growth rate is likely to be in the future. Now the blue line is supply. So it's really important to understand what the supply is and where the cycle of supply is to understand how the market is likely to perform in the next 5 to 10 years. Supply has a cycle as well, and when you overlay demand on supply, you can have a very good idea of how the market is likely to behave. Property is probably 10 to 50 times easier to forecast than the share market. As you might have seen in shares, there are some fantastic fund managers and advisors that really struggle to outperform the market. In property, it's a lot easier to forecast. It's a slower moving beast. We know how much there is, we know how many people there are, we know what the population growth is, not only in the country, but across each state and capital city, and we know how those populations are moving. We also know what the supply is. Now, as I said, the blue line is supply, but it's called supply commencements. So it's when construction starts. And on average, it takes about 2 years, mostly for units, from start to finish. So we have a really clear idea of what supply is going to be for the next 2 years. Now you can see that supply has just peaked. Supply commencements have just peaked. Now this peak point is in about a year and a half ago. Now, if it takes 2 years to finish, then that means we're going to hit supply settlements, so the completion of the property, in about 6 months in Sydney. So expect the headlines to get worse in Sydney. This is the forecast for not only supply, but also for growth. And we'll talk more about that in a minute. Now, no bonus points for knowing that Sydney had a great boom before it started to go backwards. In fact, in almost all suburbs, there was 80 to 100% growth. Some a bit less, some a bit more, but it was actually fairly consistent. But people start to forget that the previous 6 years, Sydney had a really poor period of growth. And in that time, Sydney was the worst performing capital city in Australia, with only 15% growth in total, so about 2% per annum. You might say that's okay sometimes as long as we can get a boom. But what you don't see is that the rental returns at the start of that plateau are really poor, and the property is normally costing you about 1 to 2% to own. So really you're not making any money through the plateau. You make the money in the boom. So it's all about trying to understand when the boom is likely to start. So that plateau was from 2003 to 2009, where there was really poor growth. But remember, Sydney is just one of the markets in Australia. When you look at how the other markets performed in that period, this is how much growth every capital city in Australia had from 2003 to 2009. So you can see Sydney had terrible growth. But in the same period, other markets grew by 37% up to 128%. Now this is pretty normal. The markets that perform best were going through a boom. The markets that were in the average were about halfway through their boom, and the markets that performed terribly were going through one of those plateaus. And it keeps happening. So how can we identify these markets that are just starting to boom? And which markets are likely to perform the best? Well, we'll get to the forecast in a minute. But just to reinforce how important it is to buy in a market that's about to boom versus one that's just started to plateau or gone backwards. If you can imagine, had you just bought one $500,000 property in Sydney in 2003 versus one in Darwin. Now Darwin had 128% growth, Sydney had 15. So you would have only got $75,000 capital growth in that 6 years following in Sydney, but had you bought in Darwin, it would have been $640,000 capital growth. Now, if you're getting that sort of growth, you don't just sit on it. You use that equity to reinvest and then buy in the next market that's growing. One market is not going to be the best performing market always. So as soon as we've got another 20% equity, we can use that to buy in the next market. So in that 6-year period, there's a reasonable chance you could have bought 2 to 4 properties with that equity. $640,000 additional equity is huge. So in 6 years, not only could we have been $640,000 better off if we invested in other markets, we could have quite easily turned that into being $1 million better off. And in addition to that extra growth, almost always the markets that are just starting to boom have a much higher rate of rent. It's called the rental yield. Normally rental return growth precedes capital growth. And that's one of the ways we can predict the property market. So we're looking for supply being relatively low or reducing, and rents have been increasing by 3 to 5 years. So the difference between Sydney and Darwin in that period was $565,000 on one $500,000 property. Now you might say it's not necessarily fair to compare, in hindsight, the best versus the worst. But if we look back at this graph showing the different markets, had the research only been so ordinary that we only got you from worst performing capital to the second worst, we've helped you go from 15 to 37% growth. That's not a small difference. It's actually 1.5 times the growth. Now our research almost always gets us in the top 3. Even if we got in 4th in this time, which was Brisbane in that last boom, that's a substantial difference in growth, and that's an even bigger difference when we add the difference in rental returns. This is the forecast for the next 3 years. So you might have seen on the Sydney graph, Sydney was only forecast to grow by 3% in 3 years, so about 1% per annum. Whereas East Maitland, Queensland, ACT, Western Australia and South Australia have good forecasts. In fact, there are suburbs inside these green labelled cities that have forecasts over 8 years of above 80% growth while getting really good rental returns. And so these capital cities marked in green, they're the ones where all the fundamentals are lining up for good growth. And they're the capital cities we're focusing on.